Hello everyone and welcome to the Macro Cafe episode 29. I am your host, The Cowboy. This is Elliott Wave Cafe. Let's get started. Alright, listen, you can follow me on Twitter. Come up here at Elliott Cafe. I'm picking up quite a few followers lately. I don't know if it's due to Elon Musk or, just some interesting stuff that I post out there. But nevertheless, go ahead and give that a try. And, I'm happy to have you as part of a conversation and part of the team here. Also, you can find me on this Pro Trading Room. This is on Telegram. This is my private channel where you can come and, try our services out there. Go ahead and hit that link and then they'll take you over to the bot and then you can choose whatever you want from the menu up there. All right, we're going to focus a little bit today on the S&P 500, and then I have also a few interesting charts to show you. So we're going to start here with the weekly charts, with the yearly charts. And I know we have, a couple of months before this year is over, but I want to draw your attention to what's been happening this year. And this chart goes back, obviously, to the Great Depression, and we've been obviously in a massive, secular bull market in here. And this is the first year in quite a long time, right, since the 2008 crash, when, we're starting to display some serious bearish developments. Now, you can see in here, we have the pretty nice hammer in 2020, and this was during the COVID crash. There was the collapse and then the reversal, which created a nice bullish hammer. It was followed through during 2021. With another pretty decent candle in here, but since the beginning of this year, we have been selling off. Now, some of the markets topped out in 2021 and the beginning of 2021. If you look at more those riskier stocks and riskier, beta assets, they've started to kind of top up February, March, April of last year. And then the S&P 500 at the beginning of this year, along with the Dow, and then the Nasdaq, I think, topped out in November last year as well. So anyway, if you look at this formation here, that's a pretty bearish formation. Now, we still have a couple of months. I'm not sure, how big of a rally we can stage, and if anything, into the end of the year. But I'm going to watch this very, very closely, because if this closes in any shape in the way this is right now, or even lower than what it is, then we know that we're probably going to have another year at least of bearish price action in the S&P 500. You look here back in 2000s, you've had about 3 years of bearish price action. Then back in 2007, 2008, 2009, also you've been selling off quite aggressively in here. And if you look back, back here in the 70s as well. So the longest stretch of a big bear market was back here during the Great Depression, because you've had 1, 2, 3, 4 year of relentless selling. And then you had a little bit more back in the 30s and 40s here during the World War. But this is the first kind of segment in here that starts to worry me a little bit by the way this kind of looks. So I just wanted to drop your attention on there. Look at the RSI as well. We're starting to drop below 70, and it doesn't take much to kind of accelerate to the downside in here. And usually in bull markets you stop at about 50 RSI, but I mean, if the S&P 500 on a yearly basis gets to a 50 RSI, that could be a pretty large sell-off, at least to the COVID lows, if not even lower than that. So we're going to keep an eye on this as the year progresses. Then I want to take a look at the quarterly charts, which I presented to you guys, I think, a few weeks ago in one of my updates in there. But we've had already 3 quarters of negative price action. Obviously, we're on the 4th quarter. The last quarter here terminated to an inverted hammer, right? So just a pretty bearish development out of there. And this quarter, at least, for a month and a half here, we're trying to stabilize and maybe stage a little bit of a rally. The RSI is coming back towards 50, right? Which is kind of what you want to see in terms of support on bull markets. And it's starting to kind of turn up just a little bit. So keep an eye on this one, how we're going to be closing at the end of the year. That's going to be a pretty good clue what's going to happen over the next quarter as well. But based on this candle that was on the last quarter, I would expect basically more downside. For me to convince me that this is probably going to turn to anything bullish, we got to get back about 42 to 4400. On the monthly time frames, this was a mix of candles. I mean, you've got black and white in here. You've got some bullish engulfing that really didn't manifest to the upside. Then, you've had the last month of October that started pretty bad, and then, it recovered in here. But this whole formation in here, it doesn't scream anything bullish yet, right? You don't have any type of candlestick pattern in here that tells you that there's about, that the markets are about to stage any sort of meaningful reversal. So I'll continue to watch this on a monthly basis every single month with the members and with you guys out here. But the RSI is dropping below 50, and that's a little bit of a problem. And, if that's probably going to offer resistance on the way up, and the next levels, which we haven't, the last time we've dropped below was during the COVID crisis right here. And we haven't seen that in a long time. So if the RSI continues to move lower, right, the relative strength, you're probably going to go towards 30 and maybe even oversold. And that means that there's, much larger bearish development forming in here. So, you probably noticed that I might sound a little bit more cautious than I've done in previous videos when I was a little bit more excited about the markets, because I was waiting to see if there is, anything interesting happening out there. anything to start to get a little bit more bullish developments, even from the Fed, from the price action, from some of these larger mega cap stocks, and they're just not coming. Literally, I just don't have a high level of optimism right now by the way the markets are behaving, by the way, the Federal Reserve is talking. So it starts to kind of get to me in terms of, trying to sustain anything bullish. I reserve the right to change my mind at any time if I see that the data comes in, but I want to tell you kind of what I'm thinking at the current moment and kind of what I see based on these charts. Right, so you might argue and say, listen, cowboy, maybe you're the signal that we're going bullish. Probably, and I would love that. Remember, I'm pretty long in my stock exposure and my crypto exposure and all of those. I'm just trying to get a little bit more hedges to the downside, buy some puts on the Dow Jones, sell some stocks that are bad, do some option trading around some bearish positioning, just to kind of balance out some of my long-term positions. If you look at the weekly time frames, right, we've staged, about 3 weeks of bullish price action. I think this was the drop in October 13th when we've had the latest CPI number. We're going to get another CPI number coming up next week. I think it's on Thursday. That's going to be the next, level of volatility that we're going to get in the markets. We just had the job reports, which came, still pretty strong. And the price action continues to make lower lows and lower highs in here, right? So we kind of have to stay with that trend until proven otherwise. The last week, was not that strong. You tried to rally and then, we've had the Federal Reserve announcement. They increased with 75 basis points, but, they were not as dovish as the market would have liked them to be, even though they said that they might, look at the cumulative data and how much they've increased so far, but there is no real, projected end to this rate hike cycles. Remember, the inflation remains pretty high, and we'll see how the data will be next week. I'm expecting it to drop a little bit, but still there's a huge difference between what the Fed Fund futures is, which sits at about 4%, and the inflation, which sits at about 8%. So there's a 4% gap in there that they got to cover, either inflation coming down or they continuing to raise rates. So that's kind of what we're watching. And these markets are still under that pressure from the Fed and from the economic data. So that's on the weeklies. And now let's take a look at some of the counts. And I think, if I'm not mistaken, I wanted to show, did I delete that one? Maybe, no. Let me start with this first. So, remember, I've done the last video where I've covered the S&P 500, was at about in October 22nd. I think I've done the last macro cafe where I've gone through the counts in here, and we were waiting. We counted, a pretty decent decline from those highs in here to some kind of a corrective pattern. And, this move in here was kind of, a nice clean 5-wave sequence. You can see a 1, 2, 3, 4, 5. So since then, along with the members here, we were expecting, quite a bit of a rally into the markets, either in an ABC that takes a little bit longer, or maybe a shorter B wave, whatever. But this was, what the markets kind of had in store for us, following that drop here in September. So let me take you to the longer time frames in here, and I'm going to start with this one. So this is my primary interpretation at the moment, right? I'm trying to still kind of give this bull market the benefit of the doubt and just stay with the longer term, let's say, secular bullish uptrend, right? And look at this corrections as being just kind of cyclical correction against that trend. Now, what I'm not convinced of is that the market has already bottomed. And this is due to the price action that we've been getting lately, the way everything kind of sets up, and I'm going to show you some additional charts that are supporting that. But basically, I would continue to look for this to correct lower, let's say in another decline back towards the 618. Remember, 618 is the most common relationship between a wave 2 and a wave 1. And that comes at about 3,200, and we still have a little bit more to drop. You know, the high before the COVID crash was about 3,393, and that hasn't been challenged. I think we stopped at about 3,500 in the S&P. So if this is a B wave, that means that we're beginning the larger C wave decline, which can take us towards the end of the year into the beginning of the new year, right? And the problem with that is that would create that super bearish formation on the yearly time frames. So as a bull, you really want this rally to have legs and start to push to the upside and overtake 43.25 before Christmas and even higher. So that's what I'm watching. Now, this sequence in here, it's looking at the larger degree as being a primary fifth wave, right? And this wave 3 was pretty long. And this fifth wave, it just shows it to 6,200, but, it would have to go much longer than that, right? Because wave 1, it's got this, the size of the wave 1 is right here, and then wave 3 usually is the longest wave in the sequence. It doesn't have to be, but if it is, that means that the bull market is just going to start after we're dropping, let's say, one more time, or maybe even from current levels, but this larger third wave will be massive and overtake, 6,000, 7,000, 8,000 into the S&P 500. Sure, you can have an extended wave 1 and a wave 2, and then a smaller 3, a smaller 4, and and a smaller 5th. I've seen some counts on there of people that are looking at this as a possible ending diagonal, right? Because you're looking at this as let's say an ABC, so just a 3-wave move in a wave 1, then a wave 2, so 1, 2, 3, 4, and 5. I think that's too much of a stretch in my view in terms of kind of getting that creative with what's going to happen in the market. We all know that we can all kind of make out of these Elliott wave patterns. There's like so many options that the market gives you that you can kind of draw your own roadmap, kind of how you would like it to develop forward. But I like to keep things simple. So if I look bullish, then I'm just going to count this as a wave 1, and this is a wave 2. So that's an impulse, another correction down, and then the beginning of a much larger impulse. Now on the next chart here, this one, it's looking at it as this being the top of the market, right? A much larger cycle, super cycle, grand super cycle completion up into this highs into the S&P 500, and whatever begins next, it's at the beginning of a very large correction in the markets overall. I don't know what this could trigger. There could be all kind of things happening in the world that could unleash, let's say, a pretty bad bearish markets across. And it's a little bit of an extreme count. But if this is not a wave 1, right, and it doesn't look like it's a wave 3, right, then it's gotta be a wave 5. So in my view, or I guess in anybody's view, it's based on the counts that we've seen before, and kind of the lower degree. This it can only be a wave 1, or it can be a wave 5 if you're looking at it impulsively. Okay, and that's a problem, because if it's a wave 5, that means that you're going to come all the way back here to 2250 or even below 2000 into the S&P 500. That starts as a leading diagonal in a wave 1 with a wave 2. Then you're doing another 1 and another 2, and then you begin 3, 4, and 5, 4 and 5, and then you eventually, you reach, let's say, a wave 1 primary, and then you're going to get a 3-wave setback, and then the next leg lower. So this is a multi-year bear market that this count here suggests. Now, if we're bullish, right, and if you think that this is still, some kind of an ongoing bullish market, and this is just a cyclical bear, right, then we're looking at it as a wave 1 with a continuation higher. The other argument is that this wave 5 still develops, right? If this is a 4 and this 5 wave still develops, and this cycle, the super cycle and grand super cycle, are getting delayed, that means that this move is wave 1 of a wave 5 primary. Okay, so just kind of how you have it in here, right? 1, 2, and this 5th wave continues. So that's basically the difference on it. It's either we finish this wave 5 primary, or we're doing a wave 1, 2, 3, 4, and 5, and this larger cycle, this larger move up to the upside gets still has room to develop. So it's between these two. That's kind of what we're watching and what we're digesting right now. Now, jumping onto the smaller time frames, I've showed you this, right? That's the YouTube video from October 22nd when we're looking for this rally, and the market gave us something, right? It started to push higher in this B wave, which I think it's probably complete. I mean, there is a way to kind of count it where this is just the initial, maybe an ABCW, and then you get an X wave, and then you get another ABC up for a Y, and you complete like a complex, let's say another complex B wave in here, and that's an A up in B, and then you're dropping lower in C. So that's also possible. Maybe you're getting a little bit of a rally into the end of the year in here, but I still think that until you're basically overtaking 43.25 in the markets, you're still looking pretty bearish in here with the markets overall. And this is on the smaller time frame. You're looking at the 6 hour, right, where the latest decline was in a 1, 2, 3, 4, and 5 in 34.90. This is the cash market, and then either B wave completed at about 50%, which I think it did already, and now you're beginning a wave 1, which hasn't been completed yet. That's a 1, 2, 3, 4, and 5 on the smaller time frames. I talk about these videos every single day into the program. So this is probably a wave 1 and a wave 2. So wave 1 maybe completes on Monday or Tuesday, and then you're probably going to get a little bit of a rally, and then the larger crash begins in a larger 3rd, 4th, and 5th to overtake this 3500 and drop a little bit lower. If you notice, wave B already corrected about 50% of the entire decline. In some other markets, you've had, like Dow Jones actually retraced 78.6 of the latest drop, and then the Nasdaq, which is the weakest, only retraced about 38.2%. So these two markets are not really cooperating, are not really confirming what's happening into the Dow Jones. So that's what I'm watching. And here is here is just a quick slide of comparing these markets: S&P, Dow Jones, Nasdaq Composite, and Russell 2000. And we have a lack of confirmation from these markets. I mean, if you look at the S&P 500, barely budged to the upside. If you look at the Nasdaq Composite, I mean, it's getting ready to break to new lows already, right? And the only two that are a little bit stronger is the Dow Jones and the Russell 2000, which are fairly close to their 200-day moving averages. But I don't think you can sustain a recovery and a big, let's say, the beginning of a new bull market without these two markets cooperating, right? The S&P 500 and the Nasdaq Composite, and without them starting to show signs of rallying. Otherwise, I don't think that things can be sustained. So I'm watching this every single day to see what the reactions are, and I'm expecting 1Q in here, which is Nasdaq Composite, to make new lows next week. Now, if you if you look at the FANG stocks, right, where you're having Apple, Amazon, Facebook, which is now Meta, and Google, Microsoft, Netflix, stuff like that, you look at the price section on the weekly time frames. This is the NYFNG, so this is the index that contains them, and this is making new 52-week lows, right? Where you're continuing to drop. That's a bearish move. You're dropping an Apple, which I'll show you, something that we've done in the room last week, where we faded this rally after the earnings, right? This was a clean ABC move, and I think Apple is going to go below 130 next. Then you have Amazon, which continues to make new lows. You have Meta, which, I've done a video on it. I think it's in the final stages, but really, who knows how long the 5th wave can continue, and it continues to drop in here. There's no bullish indication of a reversal whatsoever, right? They're really killing the stock. It could get cut in half from here, right? It's bad. I mean, you can't argue that until you see, a very strong move in the opposite direction. There's nothing to do there. Then Google is making your 52-week lows. It's trading at 86.58. Then you have Microsoft pushing down. You got Netflix with probably just a correction up. So, I mean, these are big stocks. And, yeah, maybe the market is rotating from something that's growth to something that's more value, energy, financials, I don't know, industrials apparently have been doing pretty well. But I don't know if you can actually begin a larger bull market just with those stocks without, having this being part of the story. So I'm keeping a close eye on this markets. And here is, a couple of things that I've said on Twitter. When I've initiated short positions here in the pro room, I said, listen, just fade this move in Apple because I don't think it's going to be sustained. So, just a little bit of a brag here, but it was clear. I mean, this guy's, come on, A, B up in C into the 200-day moving average. I mean, what else you want, right? And even on the count here, it was clean, just an ABC up as a B wave, and Apple was a big short. And I mean, you're very, very close to making your lows in Apple, right? I mean, look at the reaction. 1, 2, 3, 4, 5, 4, and 5. So I think there's more to go in Apple next week. All right, so that's kind of what's happening in there. Listen, I have in the program I have all kind of trading signals, right? I trade options, I trade stocks, I trade cryptos, whatever, especially Bitcoin. But, I do alerts for our members every time I take a trade, and I explain, kind of how I'm taking it, and you will see in there if it's an option trade, if it's bearish or if it's bullish, and kind of what's the, which issues I'm basically shorting, and if there's anything that's on the long side, I have that as well. So you get alerts on that every single time I do something. All right, let's take a look at some of the discrepancies between the markets. So this is Dow Jones. Look at the rally, right? A little bit more than 78.6, I think, just right there into 33K. NASDAQ doesn't even care, right? Nothing in there. Absolutely nothing, just a small 38.2% retracement. I mean, look at the outperformance of Dow Jones. And, I'm looking at this as a non-confirmation. And when you get the situations, that means that the bear market is in full strength, I think. Look at the discrepancy between the Dow Jones Industrials and the Dow Jones Average. Dow Jones Industrials are up here, making a pretty nice rally, and the transports are saying, I don't think so. I think there's probably a big recession coming. You have yield curve inversion. Now you have it between the 3-month and the 10-month. You have it between 10 and 2s for many months now. And the transports are not that excited about the prospects of the future, and they're not responding to what's going on in the Dow Jones. There's a lot of staples buying, which are safety sectors. And I'll show you that in a second. So again, these are not responding. Here is what I meant. The purple line here, it's the ratio between XLP, which is the consumer staple sector, and XLY, which is the consumer discretionary. When this ratio goes up, stock market goes down. When this ratio goes down, stock market goes up. When the ratio goes down, what that means is that people are dropping staples and buying discretionary, and the other way around. And you can see in here for a little while, they've been acting pretty well, but lately, you've had a huge increase in staple purchases versus consumer discretionary at the same time that the market is rallying, which is telling you that this ratio does not believe the rally, right? You should not buy safety when you're excited about a market rally, right? You should buy consumer discretionary. So this ratio here, it's hinting that this S&P 500 here is probably going to come lower. That's what this is telling, and it's making a new high above this July high, I think, or June. So it's a big signal from the market participants in here that they're piling up into safety stocks and trying to shift assets, right, from whatever generating more growth towards what generates a little bit more value and safety in here. So pay attention to this indicator. The other one I wanted to show you, and I probably showed it before. And listen, I was pretty bullish on this because, during the rate hikes, during the rate hiking cycle, you've had, pretty good advances from the markets previously. Every time the interest rates were going higher, the markets were following along. And this is the first time that this hasn't happened. We've started this huge rapid pace increase in the interest rates. Massive, right? 75 basis points at a clip in here for 4 or 5 times. And the markets, we didn't rally. I mean, we're still very, very bearish in here and pretty much coming down. So the argument here is that, everybody's waiting for Fed to pause or to cut rates, because that's going to unleash the next bull market, and you're going to get, some strong moves to the upside in cryptos and in high beta and everywhere else. But I mean, look what happens when they cut rates. Okay, these are rate hikes in orange, and this is in white is rate cuts. And when they cut rates, you're getting big declines in the markets, because every time they cut rates, right, something happens to the economy, and people just kind of fly out of there, and they start to buy stocks when the rate cutting cycle finishes off. When they go to neutral or they go flat, then you start to buy stocks. And so if you're waiting for a rate cut or a pause in here to buy stocks, I think that the next move is going to be even lower than that, right? Because that's what happens. So that's one thing that did not react as usually reacts on rate hikes, with the markets continuing to climb higher and then dropping off only on the rate cut cycles. And if we're moving, let's say that whatever, they're sitting at about 4%, they're moving maybe to 5%, right? And the markets are going lower to maybe slightly higher, just kind of continuing to correct. And then all of a sudden the Fed will pivot and will say, man, we got to cut because the economy is bad, or we're seeing signs of whatever. And then the markets will take a big dump lower, as they've done previously. So I don't know. I'm just kind of, cautioning you on this, because, the previous cycles kind of speak for themselves. It could be different this time, but I don't think so. All right, so that's kind of what I'm watching. Then I also talked to you guys when I've done a video, I think on October, the end of September, or no, I think I was talking, anyway, in the beginning of October, I've done a video when I've said, and I posted this one from the dollar, from Bloomberg Business Week regarding the dollar. Can't stop, won't stop. And I mean, look at this. This issue came in October 3rd, and the dollar topped in September 28th. At least a temporary top, right? So, you can take this to the bank, right? Because it's like, can you really top the dollar better than these magazines do? I mean, look at this thing. We've been correcting ever since, and it's not, by a long shot, it's not the beginning of a next bear market in the dollar, although you never know. The move from the highs here still looks kind of corrective. It seems like you have an ABC move and maybe an X and another ABC, and then probably you push higher in a fifth wave or a larger third, who knows. But I'm going to be watching how we develop further. If we're starting to, get back below this kind of 108 level, I think that we can probably say that this top in dollar is going to hold for a long time. So I'm continuing to watch this, but I just wanted to kind of point this out, right? How excited Bloomberg Business Week was. Like, can't stop, won't stop, and we actually did stop, right? So that's that on the dollar. So very, very interesting, because and listen, I'm going to take a couple of seconds in here just talk about the dollar. So if we have a top in the dollar, and you're asking, well, how can you have a crashing stock market with the dollar that's topping also? Well, you can still have a market in the United States that acting very weak, and you can have emerging markets that are reaching their lows, and they can start to push higher now, right? Because the dollar weakness is going to help emerging markets. So maybe it's time to look maybe towards India, towards, China, towards other markets that have already had, kind of big losses. Not India, because India has been holding pretty well. Relative strength in there was amazing, and it's trying to break the new all-time highs. I have some counts for the members, and they're in the Indian stock market, and they're pretty cool. So, but China, if they're finishing off their zero COVID policy and all that, there could be some lows forming in there. So you can associate dollar weakness with emerging markets, and maybe that's where one can look for opportunities. But, it doesn't necessarily mean just because the dollar sells off, we're going to get huge rallies into the S&P 500. So a little bit of a conflicting signal here. We'll see what happens to the dollar, but that's kind of where I'm at right now. With the count. Shorter term, I'm still looking for probably one more push higher, see what happens to the euro, see what happens to the pound, because I think pound needs to revisit the lows or get close to them one more time. Euro can probably go back towards 95, and then from there we can start to recover. You've seen at the end of this week, you've seen some pretty good rallies in Aussie, you've seen some good rallies in silver, you've seen some good rallies in in copper. So all these markets, all these kind of metal markets started to push higher. And this was basically on the news that, China might finish off their stance on COVID and might reopen fully and stuff like that. But I'm still taking that with a grain of salt. We'll see what happens next week. So long story short, let's jump over and take a look at at the crypto total market cap in here, because things have been exciting in the crypto land. You know, for the past couple of weeks, we've gotten some rallies into the altcoins. Now, Bitcoin is just still struggling. I've done a quick video, you know, a few days ago about, you know, the probability of it still being in some kind of a triangle and probably a push lower in one more move with the S&P 500 and the rest of the markets, maybe towards 14, 15K in Bitcoin after this last rally kind of finishes off. Now, some of the altcoins are acting pretty well, and I don't understand, you know, necessarily the reasoning behind that when we have, you know, all this kind of tight monetary policy overall, you know, so I can't really let's say, reconcile what's going on in the rest of the markets and with what's going on in the crypto markets. Maybe the crypto markets are signaling that, listen, you know, there's a huge rally coming and, you know, everybody kind of jump on board. But everything I've said so far regarding what's going on in the equities are not pointing to that, right? So I'm taking this rally into, you know, the altcoins as, you know, as a cautionary sign in here, right? This could be a very simple C wave, and you've gone, let's say, in an A, up in B, down in C, and then you can begin a much larger decline. So pay attention on crypto total market cap. I don't know if we're going to get back to 1.7. That's a massive resistance. You also have a declining trend line that comes from the highs here. So there's still a lot of proving that the altcoin market and the crypto market in general kind of has to do. Sure, you know, we've been basing for a while. A lot of these altcoins, you know, have had huge multi-month bases already, and they weren't able to break to new lows. I mean, ADA did, but not a lot of the others. A lot of the others, like Algorand and some of them, right? They still kind of hold a very nice base. But, you know, the question is, do I trust this rally or I don't? And what I'm thinking right now is that based on what I see, based on the evidence on the rest of the markets, that's telling me that I should not trust it. And I will trust it if the moves continue, if I can start to see a little bit better impulses, if I can see, you know, more crossover between the 50 and the 200-day moving average, if we get better established price action above their 200-day moving averages, then sure, you know, we can start to be a little bit more bullish into this field. But I would not jump, you know, straight on into the first signs of bullish momentum. I mean, Dogecoin, I don't know, guys. I think that's BS. I think this is just an X wave, and it's probably going to break lower. And if that breaks lower, you know, I don't know what's going to happen with the rest. Not that Dogecoin, you know, leads the market in any way, but anyway, Ethereum, it's outperforming Bitcoin a little bit, and here you can see that it tries to shoot a little bit higher. You got BNB that still acts a little bit good, you know, but all of these are, I think, just probably some kind of a C wave rally, and they're probably going to be met with selling. And if the equity markets break lower, I doubt that this is going to have traction to the upside. So listen, I might lose some subscribers based on these comments, but I'm telling you, you know, I'm not here to tell you necessarily only bullish news, but I'm just kind of telling you, you know, what I see, what I think, and I'm trying to stay truthful to all my subscribers and my members all the time, and just kind of tell you where I'm coming from. So again, as always, I appreciate you being here, guys. Go ahead and subscribe and like. Visit me in the pro room, you know, subscribe on Twitter. Just follow me on Twitter too. And gosh, I forgot to put the link for my Substack, because you can take a look at that Dow Jones analysis that I've done, and I think it's pretty interesting. You can go ahead and read that. It's a 4 or 5 minute read with some interesting charts on there. So go ahead and give that a try. All right. Thanks for watching, and I'll see you next time. Bye bye.